Alright, so how's it going, everybody? I'm going to be doing a deep dive on this Section 8 property. I will be buying. This one was sourced obviously directly through cold calling. This one's over in Rocky Mount, North Carolina. Market I have never been in, so I'll be doing kind of a full underwriting deep dive, show you the model I built out, and then I'll also link this actual calculator as well, so you can kind of plug in your own numbers to it. So this is kind of the raw notes, and then I'll dive into what all these tabs mean, and then we'll dive into the numbers. So property managers is just notes on some managers I'm talking to. This is our back of napkin quick screening underwriting. This is our full in-depth deep dive pro forma. This is the refinance slash sale, so the two liquidity events that we could potentially have with this deal. And then just kind of like a high-level summary on the underwriting, some of the return metrics, and then lastly, kind of the rehab that the seller already did just for our own internal notes. And again, for context, this was a deal that was sourced direct to seller from one of our no accent cold callers making that outbound call. So I'll be diving into the numbers, showing you what this looks like, and then we will hopefully see if it is a deal or not. So here is the address over in Rocky Mount, North Carolina, and here are some pictures of the property. As you can see, it looks super nice. I initially thought that it was going to be turnkey, but after having the inspector go and check it out, we realized that was not the case. So now we baked in $13K into our rehab. So I'll be breaking down this whole thing, and then we will dive into it. So overview, the purchase price is 145 grand. We're only bringing about 12.5K down. It was originally 18K, but I got a reduction. There's seller financing about 132 grand. Closing cost I estimated about 1.5%. The fee to our TC is 1,200. So our cash that I will be bringing to the closing table is about 16K. And this is a 0% interest seller finance deal with a fixed payment of $400 a month with a balloon at year 6. However, here is the caveat. I usually don't do this short term of balloons, but we have a workaround here where I told the seller saying, hey, sir, I will do this balloon. I can do a shorter 6-year balloon. However, I want to be able to extend it another 2 years if I am not able to refi at a 60% LTV and not have to write a check. So what I mean by that is, let's say at year 6, I owe him 100 grand. If I go to the bank and I want a loan at a 60% LTV, that amount has to be greater than the amount that I owe the seller. So in reality, it'll probably be more like a 10 to 12 year balloon. So quick little cheat code there. So the rehab on this thing is about 13 grand. I'm estimating 6 months of being vacant, which is an aggressive assumption. I think it'll be more like 2 months. Holding costs about $100 a month with like taxes, utilities, insurance, and our leasing fee is $450. So in total, given that holds, our total capital in this deal will be just under 30 grand. And we are renting this as a Section 8 property. As we see, Section 8 is saying it's going to be $1,900 per month. But if you know anything about the Section 8 program, it rarely is actually that amount. So I'm being ultra conservative and underwriting at $1,250. And my philosophy in underwriting every deal is I want to always underwrite the worst case scenario, and am I okay with that? Anything above that is just gravy. So very conservative underwriting. I am underwriting what is my worst case scenario, because if I am happy with that, then this will be a golden deal. The last thing I want to do is be over aggressive on my assumptions and consequently walk into a deal and not actually understand what my cash flow is. And hypothetically, if I was raising investor capital here, you always want to under-promise and over-deliver, not vice versa. So quick overview on the expenses. Property tax rate is about 62 cents for every $1,000 of value, meaning our taxes will be about 9 grand. Insurance is about $1,000 a year. Management is going to be 9%. Actually, it's 8%. I lied. Repairs and maintenance, I'm allocating for 10%. Vacancy 5%. Utilities and lawn/snow. And then other big assumptions to consider. I said our asset will appreciate by 2% every year. I will be doing 5% annual rental increases, 2% insurance increase, 2% tax increase. So again, I am underwriting very conservatively. And as we see here, just really quick, upon being stabilized, we are going to expect anywhere from an 8% cash-on-cash return to an 18% cash-on-cash return. I'm leaning more towards the latter. However, I'm looking at this expected figure, and that is something I'm comfortable with. So as we can see, this is just that quick back of napkin sniff test. Is this a deal that makes sense in looking at this quick underwriting? And of course, if it checks off this, then I go to my deeper model, and that's what I'll be diving into next. But again, just to reiterate, you always want to be underwriting these things conservatively. The last thing you want to do is go into a deal thinking you're going to get a 20% cash on cash, but in reality, you're going to break even. So a big thing people never look at is the percent of OPEX. So what I'm saying by this is, hey, of the rent that I'm getting, 40% of that is going to go to my expenses. If you are buying Section 8, you want this range to be 38 to 45%. So I'm right in the middle. Again, that is how you underwrite conservatively. And now we'll go into our deep dive pro forma here. So I'll show you how I laid this thing out. So I've got the annual, so year 1, year 2, year 3, 4, 5, and so on. And then I've got it on a monthly basis too. So if I want to see this on a month-by-month scope, and I'll just show you it like that. Give me a second, open all these things up. So again, just to kind of walk through these numbers, at the top we have, so light blue is our variables that I can kind of manipulate, right? So if I wanted to say my gross potential rent, I'm going to have a 10% annual increase, the model will reflect accordingly. So we're saying that, okay, I'm going to rent this thing for $12.50, I'm going to allocate 5% for vacancy. However, I'm assuming for the first 2 months, I will be vacant. So I'm going to be saying my effective gross income is $0 for those first 2 months. So as we see here, I'm going to be losing money in the first 2 months, right? I've got the monthly payments to the seller, I've got taxes, insurance. However, what I negotiated with the seller is I said, hey, as we see here, for the first 6 months, I owe him 0 payments. So I've got 6 months where my overhead is maybe $200 with taxes and insurance and utilities, and then after that I pay him $400 a month, just principal only. So diving from top down on this model, we have our gross potential rent of $12.50. We'll look at like kind of our as stabilized in year 2, just so it's a little bit easier. So we're saying after the increase, I'll be renting it for $13.12. Vacancy for 5% gives me my effective gross income of about $12.45. And then now for our operating expenses, I've got taxes, insurance, my management fee, repairs and maintenance, utilities, lawn care, and miscellaneous. So as we see, my total operating expenses are about $430 and giving me an NOI of about $817. Some things to think of, as you see, I have a leasing turnover allowance a leasing fee allowance and a turnover allowance. The leasing fee is my property manager. Once they place a tenant, they're going to charge me $450. Turnover means when the tenant leaves, I got to pay $1,000 to go and repair that unit. So as we see, we're expecting anywhere from $400 to $500 in cash flow per month at the start of buying this asset. Then also down here, I just have a breakdown of the asset valuation compared to the debt that I owe the seller, just so I could see what is my total equity that I'm gaining. So as we see, we built this model over 120 months. So again, if I manipulate these variables, if I see my rental increase is actually 10%, if we're looking here, as you see accordingly, that is a big assumption that will change my model greatly. So that's a full breakdown of this month-by-month model. And then over here, we've got the refinance/summary. So I built out a couple of kind of examples. Number one is, hey, at the balloon, year 6, I end up selling the property. What happens? So given our appreciation and our equity paydown, if I wanted to sell year 6, I will make 50 grand. Or at year 6, if I want to go and refinance, as we see, given my debt terms that I will get and the value compared to the debt that I owe the seller, I can see, hey, if I refi at year 6, I'll make 20 grand. So I'll have that trade-off. Do I want to walk away from this property and make 50 grand at year 6, or do I refi, recoup 20 grand in capital, and then now I own this asset still? And then a breakdown of the amortization schedule. So if I did do a refi, I then want to see what's my exit at year 10, just for the sake of this model. So quick recap, we've got our month-by-month pro forma. Again, we're modeling where we have 6 months of no payments to the seller. We're underwriting for 2 months of vacancy, and then I pay $450 for a leasing fee. And then I'm saying my average tenant lifespan is 36 months. So every 3 years, I'm getting a new tenant where I will have turnover, and I will be paying that leasing fee. Again, this is a big mistake that all these idiot gurus will tell you. They think that, wow, your tenant's going to stay there forever. No, that's not the case. In this 10-year model, I allocate for 3 times I have to go vacant, and I've got turnover, and I've got new leasing fees that I will have to go and pay over here. And now this is the most important place to look at is our summary, an overview of the deal. So I'm buying this thing for $145K, $132,000 seller finance, monthly payment is $400, interest rate 0. So my cash to close is at 12.5 plus closing costs, rehab, and then holding costs. So I'm going to bring about 29 grand to buy this deal. And here are my key assumptions. These are the most important things to see. I'm anticipating 2% appreciation I think it'll be more like 10, or sorry, not 10, like 5. My OPEX percentage is 34%. Maybe that's too low. Rent 1250, rental increase of 5%, expense increase of 2%, tenant lifespan 3 years, and then my refi LTV and interest rate. The reason I have these as the key assumptions is these are the biggest levers that I can pull in the model that will help affect my returns. So looking at the quick return summary over 6 years, if I go in refi, I'll be making a 1.9x equity multiple. We can see our cash on cash return average is 20%. My return on equity, given I'm paying down that seller finance, is 46%. But I can see this on a year by year basis for those first 6 years. Or if I want to sell it at year 6, I can see, wow, I'll 3 times my money here. So 2 amazing options that I've got the ability to dive into here. And then over here is just breaking down. This is a fun calculation that I like to do, is I'm looking at the refi versus the exit, but I'm looking at a net present value. So net present value, what that means is, given my opportunity cost, aka 12%, what are the value of those future cash flows? So that's what an NPV calculation means. And this will allow me to see what will make me most money, refining or exiting. So as we're seeing, to refi, I would pay 26 grand versus an exit, I'd pay 20 grand. So obviously I want to make 6 more grand on this deal. So in looking at this model, it makes sense, hey, I would rather refi than sell. But as we can see, I can see the year by year, the cash flow, the appreciation, the equity pay down, if I have a liquidity event, and then I can see all my favorite metrics of cash on cash as well as return on equity. So overall, this is a banger deal. As we're seeing, my average cash on cash is going to be about a 20%, which is amazing. And my return on equity, including my 0% interest note that I have here, I'll make another 46% yield there. So overall, amazing deal. And yeah, hope you got some value out of this. And again, let me know if you would like the link to this thing, and you could plug in your own numbers yourself. Thank you.